Hey everyone, and welcome to this explainer. You know, financial stability often feels incredibly elusive, doesn't it? Like you're constantly chasing a moving target. Well, today, we're going to unpack exactly why that is. We're going to completely demystify the hidden economic cycle that pretty much governs all of our lives. I promise you, by the end of this, you are going to look at the economy in a totally different way.
Okay, let's dive into this. Tell me if this scenario sounds familiar. You work incredibly hard. You finally have a little bit of money saved up. For once, you think, wow, I'm actually getting ahead. You might even start planning a wedding or, talking about having kids. Life finally feels stable. And then bam, the next morning you wake up and suddenly the market crashes.
The whole economy collapses practically overnight, and all those exciting life plans are instantly turned into pure stress. If you've ever felt that kind of sudden whiplash, I want to assure you right now, you are absolutely not alone, and it is not your fault. It feels like we're always forced to start the game 5 steps behind, doesn't it? Well, as we'll see today, this whiplash isn't just a random mistake or some streak of terrible luck. It's actually a repeating pattern. It's a structural loop. And today we're going to decode exactly how it works.
Let's start with Section 1, the capitalism loop. To really understand the mechanics here, we need to strip away all the complex charts and jargon. Just imagine a closed microeconomy, a tiny village with a baker, a farmer, a tailor, and a builder. At first, it's great. Trade is balanced, and everybody is moving forward. But then, something shifts. The pursuit of endless growth begins. The baker assumes that producing far more bread will automatically equate to more wealth. The builder starts taking on these massive projects without any secured customers or capital. Suddenly, the goal isn't sustainable commerce anymore. It's hypergrowth at literally any cost. And guys, that is the trap. The baker soon realizes he's sitting on a massive surplus of bread with absolutely no buyers, which means he can't pay the builder then can't afford to buy clothes, so the tailor loses their income. It kicks off this massive chain reaction of unpaid debts, and the whole system collapses. Why? Because reality simply couldn't support that unrealistic growth.
And this brilliantly illustrates how our economy actually operates. It's not random. It follows what we call an economic pulse. Step 1 is expansion. Interest rates are low, borrowing is super easy, businesses are hiring left and right, and you can literally feel the optimism in the air. Then we hit Step 2, the peak. Things feel a little too easy. Demand is artificially high, prices are going through the roof, and a dangerous bubble quietly starts to form. Next is Step 3, contraction. Something spokes the market. Spending slows down, businesses freeze, layoffs start happening, and sheer fear takes over. Finally, we reach Step 4, recovery. Governments step in, lower rates to get the system breathing again, confidence slowly returns, kind of like morning light creeping into a dark room, and the whole cycle just resets.
Which brings us to Section 2, a century of crashes.
Let's move to and see how this builds historically, because when you step back, this pulse isn't just some textbook theory. It's literally like someone is hitting copy and paste on a script every few decades. Look at 1929, the Roaring '20s. Ordinary people were wildly gambling with debt, buying stocks on margin. When that illusion collapsed, it led to a brutal decade defined by 25% unemployment. Jump forward to the year 2000, the dot-com bubble. The costume changed to the internet. You had companies with literally zero profit or revenue being valued at billions just because their name ended in .com. When the cheap money vanished, they were wiped out overnight. And then, of course, 2008. The religion shifted to real estate. Banks turned incredibly risky mortgages into financial fuel, and when that bubble burst, it took trillions of dollars to prevent a total global meltdown.
But here's what's absolutely crucial to understand. All of those events have one single thing in common. Maybe this time, the good times will last forever. That right there is the prevailing emotional belief that serves as the blind fuel for every single historical bubble. It happens right at the peak. It's not a loud proclamation. It's just this quiet, stubborn belief that nothing will go wrong. And it spreads like a hidden crack inside a wall until eventually the whole thing shatters.
And when it shatters, the human toll is just staggering. Take 2008. 8.7 million. That is the exact number of Americans who lost their jobs in that year alone. By the very next year, global unemployment jumped by 27 million. But, just staring at a statistic like 8.7 million doesn't really capture the reality of that moment, does it?
The real story is the person sitting in a dark room holding a bank notice, trying to wrap their head around how everything they were building just completely slipped out of their hands. The news calls it a macroeconomic recession. But a person living through it, they just feel a crushing weight. It's the recent graduate realizing the world suddenly forgot to care about their degree.
It's exciting life plans, like weddings, being pushed aside indefinitely. It's the young professional trapped in an endless rent cycle. Or a parent sitting there joking that their 401k is now a 2011k, because honestly, laughing is just easier than panicking. The system itself might reset in a year, but an actual person, it might take them a decade to stand back up.
Let's look at Section 3, Why the Gap Widens. Now, what's really interesting about this slide is how it explains why things feel so fundamentally unfair. Most people just want life to feel fair, but the wealth gap keeps widening. Why? Well, there's a fundamental mismatch at play. Working versus owning. Working means you're trading your time for income, like a standard salary. And that moves incredibly slowly. Owning, on the other hand, means holding assets, like stocks, a business, or real estate, that grow while you sleep. Assets move fast, especially when money is cheap. So when the economy is booming, owners get richer so much faster than workers, even if both groups are doing everything exactly right. Normal households have all their wealth tied up in a paycheck. So when the cost of rent and groceries rises faster than their pay, they just feel completely squeezed.
And then we add debt into the mix. Debt acts as a massive magnifier. As you can see, there's wealth-building debt and there's survival debt. People who already have assets can borrow money cheaply against those assets to invest more and accumulate wealth even faster. But people without assets, they have to borrow on much, much worse terms, and usually it's just to survive the month. It is the exact same financial tool, but it catapults one group up into the stratosphere while totally draining everyday households.
And all of this culminates in what the source material calls the crash reset. When the bubble finally bursts, you'd think things would level out, right? Wrong. The wealth gap actually accelerates. People living paycheck to paycheck are forced to retreat. They have to pull their investments right at the bottom, they delay buying homes, and they completely stop taking risks. Meanwhile, people who have a huge cash buffer do the exact opposite. They swoop in and scoop up all those same assets while they're dirt cheap. So yes, the crash is a reset, but it's not the same reset for everyone. It actively rewards those who already have something to build on.
Finally, Section 4, the next great bubble.
If you squint at the news right now, it almost feels like we're watching a movie we've seen before. The excitement is back, but this time it's wearing a shiny new face. Artificial intelligence. $1.1 trillion. Companies are treating AI exactly like they treated the internet in the 90s or housing in the 2000s, as if it's an absolute guarantee that simply cannot fail. Hyperscalers are projected to spend a mind-blowing $1.1 trillion on AI infrastructure between 2026 and 2029. Make no mistake, this is the biggest investment wave of our entire lifetime.
So the crucial point is right here. We have to look at the actual data beneath all that hype. According to a 2025 MIT study on AI return on investment, a staggering 95% of organizations using AI are currently seeing absolutely no return on that investment. Let that sink in. Only 5% are seeing a return. The belief driving the market is incredibly strong right now, just like it was in 1929 and 2000, but the math has simply not arrived yet to back it up.
And critics point to a massive potential weak spot in this whole foundation. It's a concept called circular financing. This is essentially when a supplier funds its own demand. For instance, the source notes that NVIDIA has made over $125 billion in deals investing heavily in AI labs. Well, those AI labs then use that very same money to buy NVIDIA chips, allowing NVIDIA to record that as explosive growth. It's a closed loop where demand exists largely because the supplier paid for it to exist. From an economic standpoint, it's a highly fragile financial structure.
But here's the catch. The stakes are even higher now than they were in previous crashes. Sitting directly beneath this current AI boom is over $100 trillion in global sovereign debt. The warning from our source material is incredibly stark. If AI fails to boost human productivity fast enough to justify these astronomical costs, the resulting collapse might not just be a tech correction like we saw in the year 2000. And it might not just be a financial meltdown like 2008. Because of all that underlying debt, it could trigger both crises at the exact same time.
So if the economy is this unstoppable cycle that just keeps restarting, and if each reset takes a little more from ordinary hardworking people while concentrating even more wealth right at the very top, then we are left with a pretty haunting thought. The question is no longer whether capitalism collapses, but who it collapses on. I want you to really deeply think about where you stand in this cycle. Thank you so much for joining me on this explainer. Stay informed out there, and I will see you next time.